Hello, folks. Brandon Chapman with today. It's May 19th. It's a video for TheoTrade. And boy, what's the market hold? So it's downgrade denial and what the market's really saying today. So as we look at the S&P 500, we're basically finishing down 0.12%. The SPY, for example, 0.08%. It could have been a lot bigger. I mean, if we look at their early response, in fact, let me go back to the futures. We'll come back to the SPY and why I have so many lines drawn here in a second. But let me back this into a one-year daily chart. But if we look at the S&P 500, we saw that if we go to intraday chart, 5-day, 5-minute, we saw some selling into the close on Friday. And ultimately what came out after the close was the fact that Moody's downgraded U.S. debt following suit with Standard & Poor's and Fitch. Of course, Standard & Poor's was the first in August 5th, 2011. Downgraded U.S. debt, and the market's response was about a 6.5% decline the next day. The next debt downgrade occurred in 2023, August 1st, and the S&P declined 1.5% the next day, over 5% the next week, and 10% over the next 3 months. As we look at today's response, it doesn't look like the market really is going to respond in the same way. You can see overnight we saw some bigger declines in here. The S&P is down over 1%. And suddenly we're open for business and we're buying and we're kind of just fading a little bit before the close. So what do we take from this? Are we suddenly immune from debt and deficits? The glorious bill that passed after the downgrade. Again, we didn't have it at that point. We have a scenario where the federal government generated a surplus in April. We, by executive order, passed a fairly significant tax on big corporations, which is the tariffs, because they, after all, pay it, and that's where the money comes from that go flow into the coffers. And so all of a sudden we're saying, okay, we don't have the one glorious bill passed. We have tariffs, which is raising the corporate tax, and we have a surplus that occurred in April. What's the timing of Moody's downgrade on Friday of last week? It gets really curious. We have a cartel of ratings agencies that basically Carter instituted in the late 70s. In fact, Moody's was the same company that ratings agency, among the others, that stamped credit default to CDOs, for example, back in 2000, in the financial crisis, 2005, 6, 7, stamped them at AAA that led into the financial crisis. Can we really trust them? Again, we're looking at all this, we're standing back and wondering, my goodness, what does this necessarily really mean? And we start to look at the bond market, you think, well, that should be where most of the carnage should be taking place, right? People are going to sell our bonds, and it looks like we're almost crawling back to where we were on Friday or towards the close. In fact, we might be higher than we were on Friday's close if we look back here, and we are. So bonds are getting bid. In fact, if we look at IEF today, IEF, we'll just go to the trade tab down here, and we'll look at some of the trade in the bond space on an ETF. This is an 18 July expiration. These bonds were bid today. In fact, the calls being bought, 5,000 contracts bought in one trade at the 97 strike. Well, where is the 97 strike? And we're talking about July. We're not that far away. 97's basically retesting the high from April 4th. And we back this out. Let's look at TLT. This is your 20-year plus bonds rallying off of the low today, holding the low from January. Backing this out here, back this out to let's say a 10-year weekly. I mean, right now we're scraping across the lows in TLT that we've seen over the last 10 years. Is it possible that most of the carnage has already been done in the bond market? Is it possible we might be actually in a good footing to allow bond prices to go up, that ultimately the downgrade is more just characteristic of the circumstance we're in, not so much that there were risk of default anytime soon? It's a ceremonial downgrade, right? Moody's feeling pressure to go with Fitch, to go with the Standard & Poor's and downgrade our debt a notch. Well, let's take a look below the surface today and really see, because look, if we look at the S&P 500, we are up over 20% off our lows. So I'm going to click on the low here. I'm going to bring it up all the way up to today's high. That's 23.76%. In how many days? Well, 7 bars, those are weeks. So we're talking about what? About 30 trading days, a month and a half. That's a big, big move for such a short period of time. How many times have we seen a 20% move like that and then got another 20% move, which would carry us to about 7,200? It's highly improbable that we're looking for another 20% move stacked on a 20% move bouncing off of our lows. What we've seen over the last several days, and including today after this announcement on Friday after the close, we're seeing what? We're seeing gold outperforming today, up 1.3%. The S&P basically flat on the session. We're seeing staples up here, right? In the last week, well, what's outperformed the last week? Utilities, technologies in there, but that was an early leader, okay? GLDs finally flattened off. Today, we're up 1.29%. We're seeing rotation towards staples, towards utilities over the course of the last week. And healthcare today is jumping in that mix up 0.8%. So again, what is how is the market positioning itself over the last almost week? Once we get past early last week after the news regarding Saudi Arabia and all that stuff. We're talking about more of a defensive rotation that began last Wednesday and that's continuing today. So as we translate that to gold coming off its lows, outperforming the market today, are we about to go to 315? I think what we're seeing right now is that if the S&P does continue to edge higher, that gold may likely lead out and outperform the S&P. Maybe not tomorrow because this was a big day today for gold. We're back at the close from where we were last Thursday, but we might be in a mode right now to see gold edge higher, retest prior highs. We might see silver, especially if the market begins to hold, and we might find ourselves back at 31. Maybe we're back at 30 and a half. Maybe we actually go even higher. But as we look and consider technology or higher beta stocks right now, what are we talking about? We're talking about massive rally over the course of the last month and a half, technology sector of 37%. So if we're expecting that the reaction of the market today to suggest that the S&P is looking to go significantly higher in the coming month, I think we need to temper that expectation. This is not a jubilant reaction. This is a muted reaction. And if we look at today, and we can look at Trade Flash up here, you'll see there's a large print. It says buy, doesn't matter. 1 million shares. Well, let's go to a 1 day, 1 minute. Do we see any bar here that's over 1 million? No, it's probably dark pools trade. Point being is that somebody transacted, likely in the dark pools, 1 million shares. Probably out of sequence here. So point being is that what? This establishes a level. And if we look intraday today, how have we addressed this level? As resistance, as resistance, as support, resistance. Now we broke through. We'll see where we finish in the coming minutes here as we may sag beneath that level. But the point being is that this is a level that will be significant. This level was a similar print happened back here, for example. This level was significant for a week until we finally broke through it on the 12th. Okay, that over that weekend announcement. And I get tired of weekend announcements. I want to see the ability of the market to react to the news as it comes out. I want to see traders be able to trade through it and be able to capture that move versus seeing it happen over the weekend and opening up significantly higher as the futures open Sunday night. That's not the type of market we want. But this trade here today does establish a level of significance at 593.99. Now we'll see how the market addresses it. Frequently, these can be inflection points, whether for a couple of days or longer. In fact, back here, there was one, we saw a much bigger decline. A 23% advance, certainly the market's getting tired here, and you see it in the way that money is shifting between sectors. Technology underperforming the S&P today. Gold outperforming the S&P by nearly 1.2%. Bonds, again, are bonds higher on the session today? The answer is no, but rallying off our lows, bullish option activity, I call them ghost prints occurring in the option space for IEF, for example. And we're basically anticipating that maybe we're at kind of that oversold position. And the fact we responded as positively as we did today And on relatively bad news for our debt does suggest the near-term upside for the bond space. But we'll have to wait and see. As Blake and I talked about during our joint session today on TheoTrade, the next auction might be a telltale sign. Well, what companies holding a tremendous amount, let's say $700 billion of U.S. Treasury debt at an average yield of 1%? Bank of America, right? So what is the money center banks, these primary dealers, are they going to step up to the plate? Are they going to continue to lend money to the government by virtue of buying their bonds? Is the Fed going to continue to, rather than letting their balance sheet roll off as these bonds mature, are they going to continue to reinvest those dollars back into treasury bonds again, buying them for the primary dealers? Or do they start to stand back, letting their balance sheet roll off? What happens with lending? A lot of these questions as we look forward to the days and weeks ahead with the federal government having to refinance $9 trillion, I believe, in the next year. Thank you, Janet Yellen, for putting all of our debt on very short-term T-bills to stimulate the market into an election. Great. That's productive. Now we got to roll over $9 trillion. That's $9 trillion less. That's available for who? That's available for investment in real estate, in the stock market, in a business. That's being siphoned off to satisfy the insatiable appetite of the federal government. Well, look, folks, there's a lot of risk. The sell in May and go away may not be the worst scenario right now, given the massive advance. Some people say sell in May and hold through May. They want you to hold through the summer. Maybe. What I would suggest is this: have a plan for taking profits. It's possible that gold may actually do well this summer if the market doesn't sell off wholesale. And even if the market starts to drift a little bit, there's a chance that gold continues to go higher, as we're seeing dollars go into gold as from foreign sources rather than back into our debt. We might see defensive rotations, stuff like, for example, Philip Morris today doing pretty well, right? Procter and Gamble today doing pretty well. We're seeing option flows into these sort of names today. Defensive oriented, consumer staples oriented plays. Gold, right? We're seeing it, and again, away from where? Away from technology cyclicals, and today, bearish trades in energy, specifically in Terra Resources, at a resistance up here. Can we start to see oil prices slide as the realities of lower earnings expectations, slower growth, and all this stuff starts to take hold? Layoffs, again, tariffs do have an impact. Yes, Apple's going to pay more in taxes this year. What does that mean? What do these mean? These other companies that are basically allowing the government to have a surplus for April, for example, potentially just some tariff money, right? Well, it means lower earnings. What does that mean for the S&P 500? It's certainly not bullish, right? So if we have earnings expectations starting to slump a little bit, we start to see layoffs start to occur potentially. A lot of this stuff is out there, and it did not improve over the weekend. It has not really improved over the last month. What we've seen is a high beta short squeeze in the market that's pumped it up 23%. And guess what? It was out without any real support by the Federal Reserve. If you are long the market today, you are now against the Fed, right? You are now fighting the Fed, who has restrictive policy as defined by Jerome Powell in his last statement, his last Federal Reserve policy statement and press conference. So again, we have tight policy, we have tariffs, we have uncertainty, and we're at a level right now we're starting to see over the last week a rotation towards defensive-oriented names. Yes, we had a relatively positive response to a debt downgrade, which is net negative. Maybe not as negative as you thought or hoped or whatever, but the reality is we're extended. And we are seeing a rotation over the last number of days. So take notice, right? Just know that it's okay to be long, but have a plan for taking profits. Too many people I know back here were long, and just gave it all back within a couple of weeks, thinking that, the sell-off here would produce another rally, which it didn't. So they didn't sell here. They didn't sell along the way because they're encouraged, and all of a sudden, probably some of them sold after a major correction in the market and probably missed some of this and possibly entered late, like, for example, May 12th. have a plan for taking profits, look for areas of opportunity. And right now, the cream is rising to the top. That's gold, healthcare, and utilities today. Utilities and gold, again, setting up over the last several days, along with consumer staples. So, again, look for those opportunities that provide a good reward to risk. Yeah, you can hold your tech stocks, but again, have that target in mind. Look, take profits into strength and have a plan for exiting. Well, folks, that's all I got for today. We'll catch you back on the video next week. Yeah, have a great one. Thank you.